Hello everyone, welcome to our Accounting 312. In this video, we talk about the second important part of chapter 23, performance measurement. The main idea in chapter 23 is how do we measure the performance of the managers, right? We talk about the first method, we call it a return on investment, ROI. You will not be tested on that one. Second method is residual income, RI. You are required to know that part. We said the general idea is you earn 120,000, you borrow money 100,000, and then you have the interest to pay. So now all of the 120,000 belong to you. Only the residual is yours. What's the meaning of residual? Is your income minus your you have to pay the interest, right, or pay the return. So it's your operating income minus the RR times the investment. In this video, we talk about the third method. Actually, before we go to third method, I just want to go to the last page of the first part. Fourth method is return on sales. We talk about something on something. A on B is basically just your A divided by B, right? So return on sales, ROS, is just your operating income divided by your sales. So I'm not going to talk too much about this one. You just plug the number there, you will get a percentage. So we go to the really important part. The third measure is called the economic value added. It's the EVA. I'm not sure whether you have heard this, yes or no. It's just a fancier version of the residual income. So residual income, remember we said is your operating income minus your RR times the investment. So the EVA, instead of using that one, use operating income, we use after tax operating income. Instead of using RRR, we use WACC, weighted average cost of capital. Instead of using all the investment, which is the total cost, total assets, we use total assets minus the current liability. So they carry the same logic, but for EVA, it's just everything is fancier. Now, here is what you need to know. I don't require you to do the whole formula there, but you need to know how do we get the WACC, weighted average cost of capital. How many of you heard the weighted average cost of capital, WACC? If you don't know that, that's fine. But after this chapter, after this video, I want you to get a concept. You will, I will say, I cannot say definitely, but I will say 90% you will be tested this concept and the calculation. So we call it weighted average cost of capital. What's the meaning of weighted average cost of capital? Capital is all the resources you can get to get money, right? So let's say you want to invest in a project. You need to have 100,000. How do you get 100,000? I believe from financial accounting, you already have known there are two main resources you can get money. The first one is you borrow money, right? So that's the debt. You can borrow from your family, you can borrow from the bank. I just make up a number. I say, hey, you borrow 40,000. Okay, you borrow the 40,000, which is kind of like 40%. And the other method is you issue equity, right? You issue stock, then you issue in this situation, you issue the 60,000, so which is 60%. Okay, for the debt, the bank or your family said that they charge 10% as the interest rate, 10% at the interest rate. For the equity, the stockholders just kind of think, hey, your project is kind of risky, so they require to get 14% at the return. They require to get 14% at the return. My question now is, if someone asks you, what's your company's overall cost of capital? Cost of capital, cost of both debt and equity. How do you answer the question? Can you tell them it's 10%? That's not right, because it's just the cost of debt. Can you tell them it's 14%? That's just the cost of equity. It's not cost of capital, right? It's not cost of capital. So what you should do? Some students said, oh, I'm so smart. That's really easy for me, right? Nothing I can solve all the problems. Nothing is hard for me. They say, oh, this is 10%, this is 14%, easy peasy. I take the average, right? 10% times 14% divided by 2, I got 12%. Is this accurate? I don't say it's correct or wrong, but is this accurate? Kind of got the idea, but miss a little bit thing. What does it miss? It's the average, but your 10% is just the 40% of your overall capital. Your 14% actually is 60% of the capital. So you cannot just simply take the average because they have a different weight. Now you say, okay, got your idea. We should do weighted average. I know that one is so easy. I should do weighted average, right? I do weighted average. What should I do? So I totally borrowed 100,000, and then for the debt, I need to pay 10%, and then time my 40,000, and then for the equity, so it's 14%, and then I need to pay 60,000, right? I need to pay 60,000. Or some students they just use 10% time this 40%. And then use this 14% times this 60%. Either one is fine. Either one is fine. You just do percentage, or you do the dollar amount. Either one is fine. They get the same number. So if you do the math, then that will give you. Let me see. 14 times 6. So that will give you 12.4%, right? That will give you 12.4%. That will give you 12.4%. You can say they are very kind of close, right? Kind of because 40%, 60% is almost like a 40%, 60%, almost like 50%. So this is weighted average. Is this correct? I would say almost there, almost there. Okay, so this is how you do. The logic is correct. You should do weighted average. See, our name, weighted average, cost of capital. Lisa, so which part did I miss then? Which part did I miss? Remember when we learned chapter 21, we said there is a bad guy. I personally don't like it, which is the tax, right? Because of the tax, we have to adjust for our loss. We have to, depreciation expense, those are things. So now you say, how does that affect us? Because when you have a debt, you pay interest. That will be the interest expense. That will be the interest expense. And remember, when you have interest expense, you will have a tax saving. You will have a tax saving. So let's assume the tax is 30%. So we have a tax will be 30%. So we kind of save 30%. That will not be our cost of capital. So our first step has to do the after tax cost of debt. We have to do after tax cost of debt. Instead of using this 10% raw interest rate, we just use after tax. Tax is 30%. Our after tax will be 70%. And then we time the original cost of debt, which is 10%, your original interest rate. So now your after tax cost of debt will be 7%. Your after tax cost of debt will be 7%. So this is the very important part. We have to exclude the tax from the cost of debt. We do the after tax cost of debt because your interest expense is tax saving item. So once you get this after-tax cost of debt, then you do the weighted average cost of capital using the after-tax cost of debt. Instead of using this original one, we use after-tax cost of debt. So instead of using the 10%, we just use the 7% to replace the original raw cost of debt. The cost of equity is not affected by tax. Cost of equity will still be 14% because there is nothing to do with your dividend with your tax. So we only adjust the cost of debt using the after-tax rate. Cost of equity, you do not need to worry. So our first step is get the after-tax cost of debt. Our second step is we use the after-tax cost of debt to do the weighted average cost of capital. Does this make sense? Yes or no? You said, I kind of got the idea, but I want to practice with you. No problem. Let's look at this question together. Remember, we said in order to get WACC, weighted average cost of capital, first is after-tax cost of debt, okay? After-tax cost of debt. Let's look at this, your textbook example. Okay, so let's look at your tax example. It told you said you have long-term debt. Okay, 4.5. Interest rate is 10%. Okay, so we have before tax is 10%, and then your tax rate is 30%. Oh, it's the same as our example, right? So your after-tax cost of debt will be 7%. Second step is we do WACC, okay, WACC. Your total debt is 4.5 million. Your total equity, we go back to here. Our total equity is also, hold on. Our long-term debt is 4.5 million. Our total equity, I don't know whether, our total equity is also 4.5 million. Our total debt is 4.5 million. Our total equity is 4.5 million. So we totally borrowed 9 million, right? 4.5 million. This is debt, this is equity. And then our after-tax cost of debt, will be 7%. We borrowed 4.5 million. Our cost of equity is just the original, the textbook told you is 14%. Cost of equity is just your original 14%. And then we time the total money we got from the equity is 4.5 million. So if you do the math, you will find the weighted average cost of capital will be our 10.5%. So this is how do you do the weighted average cost of capital. Your first step is you get after-tax cost of debt. Second is you do the weighted average. Okay, so I give you some examples to practice, and then I hope you feel better after the practice. I will put my note to the blackboard too. Let me know if you have any question. This is important. That's all. You say, hey, do I need to know how to get the EVA? I don't worry about that one. You will only be tested for the WACC part. Okay, thank you for the good semester. I really appreciate your hard working. Really appreciate that. I want to say I love my students. I love teaching accounting with you. Thank you for spending this 4 months with me. And then I will miss you after the final exam. Bye.